Narrow banking has been supported by many people over the years, ranging from conservatives such as Milton Friedman, probably the greatest conservative macroeconomist of the post-Keynesian era, to James Tobin, probably the greatest liberal economist of the post-Keynesian era. Well, the Federal Reserve has prevented people from setting up narrow banks. I think the commercial banks make large profits on their deposit taking, particularly when interest rates are above zero. If you just look at the difference between the interest rate that you're being paid on any bank accounts you have today and the interest rate that the bank can receive just by making deposits at the Federal Reserve Bank, you would say, well, that's quite profitable business. And this is a big subsidy to the banking industry that would be taken away if you started having narrow banks coming in and grabbing these depositors and paying them interest rates closer to the Treasury rate. I think the federal government probably also likes the current system where in this way the banks are getting subsidized because it does give them more ability to put pressure on the banks in a way they cannot put pressure on, say, a hedge fund or somebody who doesn't have a government insurance. So they can go to the commercial banks and say, we have an objective. We want to require you to make more loans to low-income neighborhoods or something like that, issue more mortgages to people who are somewhat higher credit risks. And so I'm the Richard Stepp Professor of Economics at Stanford Business School, and in recent years I've been doing some work on bank capital with Paul Klemperer from Oxford University, and to some extent also with Jacob Goldfield, who is a New York-based investor. The regulatory capital system allows banks to avoid recognizing any losses they might suffer from either interest rate risk or credit risk, and also avoid recognizing increased credit risk. For example, when the real estate market goes down, the value of a mortgage goes down, but also the riskiness of holding that mortgage goes up. So for example, let's say you buy a house for 120 and have a mortgage of 100, and then the real estate market collapses and the value of the house is now 90. Obviously, the value of the mortgage that the bank holds is lower because of that credit risk. But also, going forward, the mortgage is riskier because now the bank essentially owns the house and has all the risk of the house value, whereas previously they had a substantial cushion which guarded them against most of the initial loss in the value. And if you look at something like the US stress test, you'll see that only a small fraction of the credit loss that the market would show is reflected in the bank books, and essentially none of the increased riskiness that the mortgage has is reflected in the stress tests. In the UK stress test, by the way, you would see some reflection of the increase in risks that the mortgage would have. As we saw in the financial crisis, it's very hard to get banks to repair their balance sheets when they can say that they have enough regulatory capital. If you think about, let's say, Wachovia Bank during the financial crisis, we had a similar story where if you chart how well capitalized they were completely fine until they were broke. I don't know exactly what obstacles the regulators face, but it would not surprise me if we learned that the people who were inspecting the bank knew there were problems. These were not problems that were highly obscure. They were right on the balance sheet in Silicon Valley Bank's 10Q report for the third quarter of 2022. But forcing the banks to take prompt action might have been very difficult. This bank run bore no resemblance to the kind of bank run you see in the movie It's a Wonderful Life, which is the sort of bank run modeled by Diamond and Dybvig in their Nobel Prize winning work. In those runs, what happens is that the bank is solvent, but a panic or an act of God creates a triple market failure. The bank has depositors who are leaving and they can't seem to find anybody else to lend them money. They can't seem to sell any stock to raise additional money, and they can't seem to sell any assets except at fire sale prices. In the movie, if Jimmy Stewart wanted to sell the assets of the Bailey Building and Loan, he had to go to Mr. Potter, who was not going to offer him a very good price in his role as the villain. That said, I think what we're going to see is a big effort by various people to kind of hold on to the Diamond Dybvig bank run fire sale narrative. If you think about it, bankers, regulators, and politicians all love that model. Some economists like it because it's aesthetically a nice model. But the great thing about it from the standpoint of politicians, from the standpoint of bankers, from the standpoint of regulators, is that it's a problem that's nobody's fault. When you suddenly have a panic and people are taking money out, there's no issue of the regulation was inadequate, the rules were inadequate, the risk management was inadequate, or anything like that. It's just an act of God, and then the heroic bankers and regulators and politicians step into the breach to save the system. So you could see why that kind of model is really appealing to a lot of the parties involved. And there's going to be some cognitive dissonance. Models that kind of put the blame elsewhere, like on the market rather than on you, are always going to have appeal to people. We could see investors gradually pulling their money out of banks that they perceive to be undercapitalized. One way to think of what's happened is that by putting in these programs where they promise to lend the bank's money for a year, is they're giving the depositors a chance to front run the deposit insurer and get their money out before there's any closure. And as long as you tell people we're not going to close the bank for at least another year, then people won't panic right away. It could be that 6 months from now they'll say, oh, we better extend that program for another year, so people will continue not to panic. But I think what's happened in recent years is that the banks have been required, or at least the big banks have been required, to adopt so-called CECL accounting, which sounds a lot like a move to fair value, but apparently is much less of one than people would think. So the CECL accounting requires the banks to make a current estimate of the cumulative loss on the loans that they have. So if you had a bond, if you had a loan that was worth 100 when you made it, but you thought that you were going to have losses in the future according to your model of 10, you would have to account for that in terms of your regulatory capital. But the thing that we do know is that somehow or other these CECL losses don't seem to coincide very well with the market losses that banks have to take if they actually try to sell their loans. I have to tell you, when I first came to Stanford Business School, it was with my graduate student classmate, Ben Bernanke. So every day for 6 years, I had lunch with the chairman of the Federal Reserve Board, and I still know nothing about macroeconomics. That said, I don't think this will hamper the Fed's ability to control inflation. When Christine Lagarde announced about a week ago that she would raise European interest rates by 50 points, but at the same time work to protect the European banking system, the market seemed completely fine with that. When the British government had a crisis in their pension fund industry that required intervention in the long end of the gilt markets not so long ago. They were able to develop a policy that let them do that, but at the same time continue their inflation fight. And I would predict the same of the Fed, but it's not something where I'm a big expert and I could easily be wrong. So narrow banking has been supported by many people over the years, ranging from conservatives such as Milton Friedman, probably the greatest conservative macroeconomist of the post-Keynesian era, to James Tobin, probably the greatest liberal economist of the post-Keynesian era. There are slightly different ways you could do this. One way would be you could imagine insured bank accounts becoming like federal money market funds and just operating that way. More generally, narrow banks would back deposits with a narrow set of very high quality collateral, probably short-term government debt, maybe short-term or variable rate government agency securities. So it would be a set of securities that are highly liquid, easily valued, and where you wouldn't really need very much, if any, capital requirement or reserve cushion above the value of the deposits to make them perfectly safe, or as safe as the U.S. government. Well, the Federal Reserve has prevented people from setting up narrow banks. I think the commercial banks make large profits on their deposit taking, particularly when interest rates are above zero. And if you think about it, what happens? The banks acquire depositors who are likely to leave their money in for a long time. And why are they willing to do that? It's because the bank goes to the deposit insurer and says to the insurer, look, you're going to have an unsecured claim against my bank. In return for that and a few basis points worth of deposit insurance, you're going to provide me with an equal amount of government insured short-term debt, which I can then provide to my depositors. So that's a very good deal for the bank. And they get competition from other banks, of course, but if you just look at the difference between the interest rate that you're being paid on any bank accounts you have today and the interest rate that the bank can receive just by making deposits at the Federal Reserve Bank, you would say, well, that's quite profitable business. This is a big subsidy to the banking industry that would be taken away if you started having narrow banks coming in and grabbing these depositors and paying them interest rates closer to the Treasury rate. I think the federal government probably also likes the current system where in this way the banks are getting subsidized because it does give them more ability to put pressure on the banks in a way they cannot put pressure on, say, a hedge fund or somebody who doesn't have a government insurance. So they can go to the commercial banks and say, we have an objective. We want to require you to make more loans to low-income neighborhoods or something like that, issue more mortgages to people who are somewhat higher credit risks and so forth. And the bank, because it relies on the government for the deposit insurance, which is the backing for so much of their funding, kind of has to accept a certain amount of that kind of thing from the government. Whereas a hedge fund might say, I'm sorry, I'm not in that particular business. I'm not going to make those kinds of loans. It's a little bit ironic that if you think that part of the way we got into this problem was by banks being able to not recognize their losses and depend on their insurance. The way we're temporarily solving it is by allowing them to continue to not recognize their losses and rely on even more insurance. Going forward, there might be a few things that we could do that would improve things. So, for example, I think it would be good to move bank regulatory accounting to where it depends more heavily on market values. And that will probably take some time because these banks have losses. And my instinct would be to say to the banks, okay, we want you to move to market-based accounting, to fair value accounting, as banks like Goldman Sachs primarily already do. They have very little in the way of hold to maturity balances, some, but very little. Take as long as you want, as long as you feel like you need to do that. However, until you do achieve it, then any dividends that you pay to your shareholders must be offset with an equal amount of stock sales. So, in other words, say to the bank, you can't be making net distributions to your shareholders until you correct the accounting problem and are well funded on a market value basis. And if you feel that takes you 6 months, then it takes you 6 months and you can start distributing capital again very soon. And if you feel it takes you 7 years, it takes you 7 years. My feeling is that the existing contingent convertible securities that are on the market have two kinds of problems that Paul and Jacob and I would correct in terms of what kinds of securities ought to be issued. So one kind of problem is that conversion is on a basis of regulatory capital rather than market value. So these bonds were designed to meet regulatory capital requirements rather than market capital requirements, and they will typically be set up to be something like, if the regulatory capital falls below a certain level, then the bond becomes worthless or converts in some way. The other thing is that the entire bond converts at once. So if you had a regulatory capital trigger and you have the regulatory capital fall below that level, then the whole bond converts, and that can lead to a lot of gaming to try to keep the regulatory capital above that level, for example, and a lot of pressure on the regulators to go easy on the bank's accounting, because the bank will say, oh, if we have this conversion, it's going to start a panic or something. So the way we designed equity recourse notes was to say, first of all, let's make the conversion based on the market price of the stock. So, for example, if you are borrowing money when the stock price is at 100, what's going to happen is that conversions will occur when the stock price is below 25. So if the bank is well funded and it has a fortress balance sheet and its stock is never going to fall by 75% or more, then the bondholders will just get paid as normal bondholders. And the second thing is that if the price falls below 25 in the example, what happens is that the only thing that converts is the payment due on any particular date. So if the stock is selling at 20 when the conversion price is 25, then essentially for every $25 worth of cash that the bondholder would have received, they only get $20 worth of stock instead. So that has a few advantages. I mean, one is that as they go down, a conversion signals nothing that's not already in the market. The conversion is based strictly on the market. So the fact that the regulator is allowing a conversion to take place does not signal anything about the regulator saying, oh, these guys are really in trouble, we need to have their COCOs convert. Just blame it on the market. It also means that you're not doing something quite as dramatic. You can say to the bank as the regulator. Well, look, all that's happening is your current interest payment is being paid in a stock. You guys are not doing so well. Maybe it's just as well that you save some cash and essentially sell stock for 25 when it's only worth on the market 20. And so what happens is that the incumbent thing is if the bank is in distress and the stock is way down, you just, as regulator, don't have to do anything. And you have these conversions. We would make most bank debt work this way, frankly. There could be funds that would pool and tranche this kind of bank debt and create some debt that would be higher priority, just as people buy a bunch of mortgages and pool and tranche them, but it would work much more simply than in something as complicated as a mortgage. We would tend to combine a proposal to issue these kinds of bonds with a narrow banking proposal. But you're right that if you think about the debt that the bank would have to issue to fund its lending and so forth, the interest rate on that is going to be affected by people's perceptions of how safe the bank is in a situation where one way to put it is the property rights and all the losses will vest in the private sector rather than be transferred to a government insurer. And you have these bank executives like Jamie Dimon who say, we have a fortress balance sheet, we're not at any risk. Our debts will all be good, our bonds are safe. It's not because of the federal government, it's because we're financially so strong. And if he is able to get private sector lenders to agree with that assessment, then he should be able to sell bonds of the kind I've described at prices that don't involve a large risk premium. If, however, investors are more dubious and think there is more risk in those bonds, then our preference would be that that risk and the higher interest rate be simply reflected in the price that JP Morgan has to pay to issue their debt, rather than in them being able to go to the federal government and say, oh, look, see how much regulatory capital we have. We're safe. Why don't you just insure all of our debt for a 4 basis point deposit insurance fee, rather than having us go into the market and have to pay 150 or 200 basis points or whatever the number might happen to be. I don't think we should expect these bank regulators to be able to make a decision that says, oh, the market thinks that the charge should be 150 basis points, but we think the market's being crazy, it should only be 4 basis points. Maybe the market's wrong, but you have to allow for the possibility that sometimes it's right. There's essentially a theory that we are able to fuel investment by allowing banks to be undercapitalized and but backed by government guarantees. So whether you want to say weakly capitalized or over leveraged, but backed by government guarantees. Of course, we saw in the financial crisis that when the banks really became weak, they actually started to cut back on their lending. What they would do is they wouldn't sell their old loans, because if they sold their old loans that were worth 50 cents on the dollar, they would take a big regulatory capital loss. But they stopped making new loans. I guess my instinct would be to try to have the banks meet market capitalization requirements, and if that required in the long run central banks to use interest rates that were lower than they would otherwise to make up for it, that would be fine. But and again, I could be wrong, but I'm just not persuaded that the way to stimulate investment is to say to the banks, we're going to let you be undercapitalized, and that will allow you to be over leveraged, and that's the way we're going to stimulate investment. It might be the right way to go, but I'm thinking maybe we can do better. Yeah, so my view about the stress tests is that their purpose is not to tell investors that a bank is actually solvent. It's in fact to give the uninsured creditors of the bank comfort that the regulators won't close the bank down anytime soon, and that as a short-term creditor, you will be able to get your money out. If you think of the initial stress tests in 2009, they were at a time when the banks were already in very bad trouble. And the stress tests said, well, what's going to happen to their regulatory capital? Will they be shut down if we not only have the current situation continuing, but things get even worse? And then the answer was, well, we need, out of the 30 or so US banks that were tested, we need some of them to raise a total of $75 billion, which wasn't very much. And the Europeans concluded that except for some cajas in Spain, which were government run banks, and a bank in Germany, I think Hyperion, which was already in bankruptcy, nobody needed to raise any more money. Now, how is that possible? Basically, what it was that you were saying to people, look, no matter how bad things get, we are not going to make these banks recognize very much of their regulatory capital losses. And so maybe they're insolvent, but you can be sure, as the US government promised to people in early 2009, that for at least the next couple of years, we're not going to be shutting anybody down. And so if you put money into these banks, if you're a short-term creditor, if you buy their 6-month commercial paper, you can be absolutely sure that we're going to let the bank pay that off. And as a creditor, what you care about is not whether the bank is solvent, but whether they will be kept in business long enough for you to get your money out. So that, I think, is the real purpose of the stress test.